Welcome to Daybreak Asia. We are counting down to Asia's major market opens.
And Australia has just come online. The top stories this hour. Japanese firefighters are still battling blazes after a powerful earthquake killed at least 4 people. Authorities are warning of further aftershocks with tsunami alerts still in force in some areas. Iran sends a warship to the Red Sea after the US Navy sinks Houthi rebel boats, potentially ratcheting up tensions in the vital waterway. Plus, a Bloomberg scoop revealing that ASML cancelling shipments to China ahead of a January deadline under pressure from the Biden administration. All right, let's get you straight to the market open here in Sydney. Of course, just coming online after that New Year's break. We are expecting volumes to be pretty thin. Of course, January is a very slow day when it comes to corporate activity here in Australia, but we are seeing just a modest upside as we get underway. Asian stocks more broadly, though, may be lacking that kind of New Year cheer as the new year gets underway. We had, of course, in terms of topics of focus, a Chinese president pledging economic strengthening and job creation from that speech from Xi Jinping. We have seen weakness, though, in the futures picture, at least for Australia. We're seeing about a tenth of 1% lower as we get into the start of that staggered cash open here. We're also watching the Aussie dollar at 68.13. We had a pretty bad year for the US dollar, and whether that will continue and create further uplift for some of these Asian currencies, including the impact of commodity prices on the Aussie dollar, will be one to watch as a theme this year as well. Kiwi stocks are doing not much of anything at the moment, to be honest, just fluctuating between slightly lower and slightly higher this morning. We are watching, of course, when it comes to Japanese assets in the wake of that powerful earthquake that happened on New Year's Day that killed at least 4 people, triggering that widespread tsunami warning, which has been partially lifted. Japanese markets are closed for a national holiday, though, but we are watching when it comes to the yen trading at just shy of that 141 level. Chicago Nikkei futures are looking a little bit softer at this point. And also watching China A50 China futures there up by about a tenth of 1%. And Yvonne, it was a lot to pass through when it comes to the guidance, I guess, or the messaging from President Xi Jinping, that finally balanced, acknowledgement of some of the shortcomings and the challenges ahead, but also trying to project a picture of domestic strength as well.
Yeah, and I think that is the key question for many investors this year when it comes to China, right? Are we just going to muddle along when it comes to this economy? I mean, those PMI numbers certainly suggest that there continues to be this weakness in the economy. And then you continue to look at the geopolitics. And we're focusing on ASML in particular here this morning. The company out confirming a partial Dutch government ban of some China shipments. Of course, we have seen the likes of some of these chip makers aligning a little bit more with the U.S. and what they're doing to try to de-risk, I guess, from China in some ways. And we're now getting that confirmation from ASML of this government ban. Certainly one to watch here as we count down to, of course, this chip turnaround that everyone's forecasting for this year, and really how is this going to play out in terms of U.S. and China tensions, of course, as well. All right, we'll get to that story a little bit later on as we flesh things out a little bit more. Let's get to the latest when it comes to Japan. Authorities in the country are warning that there may be further aftershocks following Monday's powerful earthquake. The magnitude 7.6 quake on the northwest coast killed at least 4 people and triggered a widespread tsunami warning. We have learned, according to NHK, that parts of Japan have lifted that tsunami warning for now. Joining us for the latest in Tokyo is Isabel Reynolds. Isabel, just walk us through, bring us up to speed. What's the latest now?
Right. Well, in fact, the latest we're seeing from NHK is that 6 people have now been confirmed dead in this enormous earthquake, in fact, which is 7.6 magnitude. It's very rare to see one of that size. If you look at the video that you see on social media and on the broadcasters here, it was an extremely powerful quake. You could see the buildings shaking. Some of them were falling over. Roads were buckling and falling away. It must have been a terrifying experience for those in that area. Obviously, the rescue process is ongoing. We can see there on the screen this massive fire broke out in the city of Wajima, which is a rather sort of quaint old town with a lot of wooden buildings. More than 50 of them were involved in this fire, and it's still ongoing more than 12 hours after it broke out.
And you mentioned some of the fires affecting more than 50 buildings still. We are seeing quite a bit of impact on local infrastructure.
Yes, that's right. Trains on the Noto Peninsula, which is that little peninsula sticking out into the Japan Sea, have been stopped. Some other regional trains have also been stopped. The local airport has been closed due to cracks in the runway. So roads, obviously, some of them have had to be closed due to damage, and that must be affecting the rescue attempts. So although we're only seeing 6 deaths at this point, sadly, I think it is quite likely that that number will continue to rise over the day now that we're getting into the daylight, and rescuers, which include the armed forces, Japan's armed forces, will get into those more remote parts of the peninsula.
Isabel, of course, Japan is I guess prone to these sort of earthquakes before. This brings us back to memories of Fukushima in some ways. But can you tell us what does it mean for the nuclear plants in the area and electricity supply more generally in Japan?
Right. Well, what we have seen happen, which is a definite effect, is that one of the thermal plants has been taken offline due to the damage. What this has meant is that we've seen power outages in the area, which is it's obviously a very cold time of year, so that's unpleasant for the people there. But it also could play into the power supply over the coming months. Japan has not had to call for people to cut back on their energy use because they thought they had enough power for this season. That could affect those calculations, and that could affect the way people get to use energy in the rest of the country. As regards to the nuclear plants, as of now, the nuclear authorities say that there has been no abnormality right as of now. So there's no need at this point to be concerned about a nuclear disaster of the type that ensued from the Fukushima disaster.
Bloomberg's Isabel Reynolds there in Tokyo with the latest. And Iran has dispatched a warship to the Red Sea after the US Navy destroyed 3 Houthi boats on Sunday. The move could be seen as a challenge to the US-led maritime task force established to halt attacks in the area. It also risks ratcheting up tensions in the waterway that handles about 12% of global commerce. Bloomberg's Michael Heath joins us now. So, Mike, how do you read into this situation?
Yeah, look, I mean, that happened too as a Houthi representative was in Iran. In a sense, I guess it's Iran signalling that it's not going to be intimidated, and it's going to make sure that its waterways or its territorial waters are clear. But it's a real shadow play that's going on between the US and Iran now. The US the Biden administration is trying very, very hard to ensure that the conflict does not spread, whether that's in southern Lebanon with Hezbollah, whether it's with the Houthis. It has its maritime group that's trying to dissuade the Houthis and intervene with weapons. But the whole aim is to avoid this ratcheting up. The temptation to strike Iran must be very strong. Excuse me, because all of this sort of originates from Iran. All the funding in terms of Hezbollah, Hamas, the Houthis, but the Biden administration is trying hard not to do that. But Iran wants to keep its prestige up as well with its axis of resistance that it calls this group. So yeah, it's a lifting of tensions, but it's probably not at this stage going to send us any further, I think.
Michael, can you tell us a bit more about the changes in Gaza as well, with Israel withdrawing thousands of troops there? What does that signal to you?
Yeah, Yvonne, I mean, the description from Israel is that it will allow these soldiers to return to the economy. The Israeli economy has taken a real hit, obviously, from this war. Not only is it costing billions of dollars to prosecute, but it's taken a lot of these reservists out of the workforce. So they're making the argument that part of it is to sort of normalise things in terms of the economy, but it does sort of signal to me that, the suggestion is that it's part of Israel moving to a more targeted campaign. I mean, we've had the bombing of the Strip. We've had large-scale ground forces that have gone through. We've still got intensive fighting going on in the southern part of the Strip. But at this stage, it looks like they're now moving to sort of more targeted operations where they're trying to eradicate certain leaders or clear certain districts, but not quite that full war ground force that you see in sort of state-to-state kind of war. So I think it does herald the move to a new phase of the war that we're seeing. Just the early part of it at this stage. It's a few thousand troops, is my understanding.
All right, Michael, thank you. Michael Heath joining us in Sydney here with the latest what we're hearing from the Middle East. And sticking to Israel now, so the Supreme Court there has overturned a law aimed at weakening judges' powers in a blow to Prime Minister Benjamin Netanyahu. 8 judges voted to overturn, with 7 in favor of keeping the law, which would have barred them from voiding government decisions. The law was part of a populist overhaul which split the nation, with thousands of people taking to the streets to protest the planned changes. Ukraine says it shot down almost 90 Russian drones on New Year's Eve as the war grinds towards a third year. It followed Russian missile attacks over the weekend that killed at least 30 people in Ukraine. Moscow has said it would seek revenge for a missile strike on a border city that killed at least 24 people. A series of tit-for-tat aerial assaults have intensified recently, with the ground conflict in a stalemate. Chinese President Xi Jinping has told his U.S. counterpart, President Biden, that their country should strive for a peaceful coexistence. In a New Year's Day letter commemorating diplomatic ties, Xi noted China-U.S. relations have contributed to global peace and stability. Ties between both countries have steadied since Xi and Biden met in San Francisco last November.
Let's get some more when it comes to our breaking news a bit earlier. ASML confirming that a Dutch government ban of some of its China shipments. And of course, this really takes effect as we continue to watch as one of the key risks going into this year, these ongoing tensions between the US and China. So much of that has been focused on the tech sphere, and so much of that potentially further in focus as we get into this key election year with that US presidential election in November as well. So let's bring in Annabelle, who has more details of this. And Belle, what do we know?
Well, I think you've got to really understand the significance of how important ASML is to the overall chip-making process globally, because it produces these so-called ultraviolet lithography machines. A lot of details to that, but really just at the basic level, what you need to understand is that ASML has the capability to print tiny features that form the basis of a microchip. It's very, very important when you get into this a very advanced semiconductor phase, and so it's very unique as well in its capabilities in this sort of chip-making process. Now, we know that the Biden administration really wants to be able to limit China's capabilities in producing advanced semiconductors, and so it's been putting pressure on allies like the Netherlands, like Japan, to restrict exports of chip-making equipment to China. Now, these took effect January 1, but what we understand and what we reported on, because actually Bloomberg was the first to report on this, that some countries got a head start on the process. So ASML actually had the licenses to ship 3 of its machines or devices to China. We understand that these were revoked or cancelled, and so those actually haven't been sent across. And so ASML, as you just mentioned, they would really have just confirmed that news, essentially, that the Netherlands revoked their shipment license partially. A number of Chinese customers, we understand from the company, are impacted by this. And so ASML also saying, though, that that license being revoked really won't impact its financials, but still it really just is about saying that there was that export restrictions that have taken effect, and some countries have got ahead of it, and how important really ASML is to the White House's ambitions to try and restrict China's capabilities in this field.
Yeah, it's interesting that President Xi, talked about this peaceful coexistence that he strives with hopes to have with the U.S. as well. I mean, he acknowledged also not just the geopolitics, but in his New Year's message, really the economic challenges that China is facing here right now. I want to play a clip real quick. Let's take a listen.
On the road ahead, wind and rain are normal. Some enterprises are facing operational pressure, and some people are encountering difficulties in employment and life. And natural disasters such as floods, typhoons, and earthquakes have occurred in some places, all of which I'm deeply concerned. We are not afraid of hardships. We will watch out for each other, face up to the challenges, and overcome the difficulties.
Yeah, he spent quite a bit of time really admitting, these difficulties, which is quite rare from the president, Annabelle.
Yeah, it's not really something we hear that much from Xi Jinping, but of course, when you take a look or you really just think about the issues that China's economy has faced over the course of 2024, or 2023 rather, it is a little bit unsurprising given you had things like the property sector slump, high unemployment, particularly amongst the youth, the market rout as well that we saw in stocks. So yes, an element of concession to it, but still it's important to think about how Xi Jinping is planning to respond to those challenges, and that really was a focus of his address as well. So things like a pledge to strengthen the economy, to create more jobs and better opportunities as well for young people inside China. A little bit of grandstanding, as you might expect as well. So he reflected on some of the homegrown projects and successes for China over the course of last year. So things like a cruise ship that was made locally. There were space programs as well. There was the developments that we saw in China's aviation ambitions, because we had that C919 jet, or passenger jet from Comac, making its first trip outside of mainland China.
Annabelle here in Sydney with the latest. More to come here on Daybreak Asia. This is Bloomberg.
All right, Happy New Year. We are in store for some pretty key data coming out this week as well. So we are kicking off 2024 on a pretty busy few days here. So kicking off first with the Australia December manufacturing PMI. That came in at 47.6. So further contraction from November. There are signs of disappointment on that one. On tap later, we have PMI readings coming out across Asia. You have fourth quarter GDP and full year GDP figures coming out of Singapore. You have Fed minutes on Wednesday. You got JOLTS data, ISM manufacturing numbers out of the U.S., and then more employment news for the Fed to digest on Thursday. Yeah, initial jobless claims, and then, of course, to wrap up the week, we got that non-farm payrolls coming up on Friday as well. Also, keep in mind, we also have some inflation numbers out of Thailand, Taiwan as well. Don't forget, we have that election in Taiwan happening in just about 10 or 11 days or so from here. Alicia Garcia-Herrero, Chief Asia-Pacific Economist at Natixis, joins us from Taipei. Alicia, I'll get to Taipei in a moment, given what's going on over there. But, we got to talk about this year that we're about to start off, and where, this time last year, I was just talking to a previous guest, right? The three most popular trades out there was to sell U.S. stocks, buy China stocks, and buy treasuries. And all that didn't quite play out as planned. Is 2024 going to be better than last year?
Well, it was good for some. 2023, those who actually played, very differently, as you said. And I think the play was, as we have now, everybody's, short dollar will be weak. We heard that last year. So I think there's chances this year that the dollar will be weaker because the Fed will indeed cut, no matter, I think, the strength of the labor market, which we will check next Friday. But the key here for the Fed to be successful is really to make sure that real interest rates won't become very high. And this is actually the situation in China. So the key is not so much how quickly nominal rates come down, but how quickly inflation comes down at the same time, so that you don't have very, very strong real interest rates, which kill the economy. That's what we need to watch. I think that's the key even for equity markets, to make sure that, these nice labor conditions continue and that the economy decelerates slowly but steadily without creating havoc.
Mm-hmm. And I mean, how are you looking at those risks right now? Are they looking more, asymmetrical? Is it more symmetrical now? The risk between inflation and the recession risks out there. And what are some of those potential choke points that you're looking at for this year?
For me, trade is a huge choke point this year. The IMF has warned us since their last annual meeting, and I think they're quite right on focusing on both trade fragmentation and, frankly, increasingly financial fragmentation. But if we focus on trade, beyond what we just heard, from Bloomberg on ASML and the tech-related trade fragmentation, whether it's export controls, export licenses, you name it, we also have China trying to integrate vertically as a response, also rightly so, to the pressure from the rest of the world, whether it's the threat for protectionist measures on Chinese electric vehicles, all of the green tech that China produces, which is at the top of its exports. And I think that's a big, big risk, both for China, but also for the rest of the world, because China will try to control imports as a response, because that is growth for China. External demand is going to be what China is going to rely on for Xi Jinping to really come up with this, deliver its promise in its speech that China will grow fast in 2024.
And we have seen these green shoots in trade, right? I mean, are these positive signs to you that we're seeing the bottoming out of this export cycle? What do you think, global demand is going to look like?
Well, for those who were really at the bottom, as you said, Yvonne, like, say, in Taiwan, South Korea, those really suffering from the humongous stoppage of ICT products or semiconductors, low end especially, during the pandemic, right after the pandemic, those are going to do better just because they were so low. But that's just one part of trade. If you are selling anything else, whether it's machinery, chemicals, combustion engine cars, those are not going to do any better in 2024. So I do think that, except for the ICT cycle, 2024 won't be a good year for trade, unfortunately.
And you mentioned about these shifts in trade. We saw it in the export numbers coming out of Korea, right? That they're actually exporting more goods to the U.S. More so than China now, where the U.S. is now their number one market. I know it's just one print, but is this a sign of shifting trade patterns to you? And is it really just geopolitics related?
I don't think it's only geopolitics. It's a great point, because the part of that, if you think about the U.S. importing less from China because of IRA, South Korea, for example, is by now really benefiting from IRA because of exemptions to EVs and the like from Korea. But it's more than that. I think in a way it's also consumer preferences that are changing. And that's much harder to control, from China's perspective. That's more structural. There's also regionalization of trade. Climate change related. There's lots of things happening at the same time. And I think we need to realize that, yes, trade patterns are changing.
And certainly Taiwan is caught in the middle of these geopolitics as well. And where you are, Alicia, we're just a few days away from this national election. What would another 4 years of DPP rule mean? If in fact the polls suggest that there's still that lead that Lai Ching-te has, what would that mean for the economy there?
Well, the economy, and this might not be related to the DPP because it was the pandemic really that brought Taiwan to grow well above potential in 2020, 2021. This was the huge demand for ICT and semiconductors. 2023 has been quite miserable for Taiwan, so growth really around 1.5 or so. 2024, for the reason I mentioned before, same as South Korea, will be better for Taiwan, no matter who wins. It's just a cycle. Policies actually are very similar, even across the board, except for China.
Alicia,
so it won't make a big difference.
We got to leave it there, but thank you so much, Alicia Garcia-Herrero, their chief APAC economist at Natixis. We got plenty more to come on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. I'm Annabelle Drawlers here with a check on markets. It's pretty steady going as we head into the first trading session of 2024. You can see behind me some very muted gains coming here across the board, but generally the session today looking quite range-bound. There are a couple of markets that are shut. Japan, New Zealand, they're the key ones really to note for this region here, but coming off the back really of some weakness that we saw in the prior session on Wall Street. So it tells us again that it could be pretty range-bound, subdued trading activity. I just want to demonstrate that a little bit more in detail. If you bring up the AVAT function, check how Aussie stocks are trading so far 30 minutes into the session, and you can see when you take a look at that trading activity is around 75% lower than where it would be at this point in time on a typical 20-day moving average basis. So a lot of investors and traders probably still away for a holiday break. It is, though, that question of how markets are going to be performing over the course of this year. There is some expectation that there are some strong things that are moving in favour of markets, even though at a fundamental level valuations are perhaps a little bit toppy, a little bit stretched in the session. Let's change on. It does really depend on the direction of where the Fed goes from here, but as you can see from that terminal chart just behind me here, a lot of Fed cuts are still priced in over the next 12 months. So traders, when you take a look at Fed fund futures positioning, seeing about 4 cuts of on.
Yep, continue to see those Fed cuts being priced in here today. That's going to shape the direction of the dollar. Our chief rates correspondent for Asia and MLI contributor Garfield Reynolds joins us now. Garfield, we continue to see this weaker dollar story. I mean, are we likely to see that this is just the beginning of the decline in the dollar?
There's a decent chance that that's the case, especially in the short term. The expectations are very strong that the Fed will be cutting and that it will end up cutting earlier than the Fed itself has said it expects to. Now, there's not a huge amount that can get in the way of that expectation in the early running. So that is going to build the case for a weaker dollar, at least in the short term. A lot of that is going to be driven, you would think, too, by Japan. We had reports over the weekend of plans for some strong wage increases. Now, that's only anecdotal so far, doesn't necessarily add up to a case for the BOJ to reduce its massive quantitative easing and its yield curve control. But that case has been building anyway. That's going to mean the yen is currently trading at about 149, just under 149 per dollar. Plenty of scope for that to go down towards 130 as the expectations build that the BOJ is finally going to move towards doing what many people have been waiting years for and reduce the amount of money it's just hosing into the Japanese economy. That's going to drive dollar weakness, and it's going to encourage that general anticipation that the US very much led the way up when it came ultimately to tightening policy. Now it's seen as leading the way towards loosening policy. That should bring a weaker dollar for the first few weeks, maybe even a few months of the year, if not further.
Garth, we saw the first Treasury's gain since 2020. Is that Fed narrative pretty well set going into 2024?
Again, I mean that's part of the same phenomenon that is expected to drive dollar weakness. If bonds don't keep rallying from here, which means if yields don't keep moving down, that dollar weakness narrative would lose a lot of its strength. And again, at the moment, when you've got 150 basis points of rate cuts priced in for the Fed, and the expectation is going to move before others do, plus the fact that at just under 3.9% for 10-year Treasury yields, that's pretty appetizing. It's higher than anybody's had to play with for a long time, especially in an environment where yields are expected to move down. So the expectation is going to be further declines in 10-year yields. The big question remains, does the Fed engineer a soft landing? If it does, then we should expect a much shallower reduction in yields. I still think you'd argue they would go down from here, but say 10-year yields might stabilize at about 3.5%. In a soft landing scenario, maybe edge down towards 3.25. If you get a hard landing, then you're looking at 3% and then under 3% by the end of the year.
Our chief rates correspondent for Asia and MLive contributor Garfield Reynolds there. Well, some tsunami warnings are still in effect in Japan after Monday's earthquake off the Noto Peninsula. More than 50 aftershocks have been reported, with broadcaster NHK saying at least 6 people are now confirmed dead. NHK also reporting that firefighters are still battling blazes in the city of Ujima, where around 50 buildings caught fire. The city was also hit by a tsunami of at least 1.2 metres, the largest reported. Let's bring Zohair Khan, who's a senior portfolio manager at UBP, to join us. And Zohair, before we get into sort of the broader outlook when it comes to Japanese assets for 2024, of course, we do have Japan markets are closed for a national holiday today. Do you expect to see much of an impact from this disaster, and how does that potentially play out?
I mean, it's really a terrible event, but fortunately the tsunami so far hasn't been that large. Tsunamis cause the greatest destruction, so we're hopeful here that the worst of it is behind us. Japan tends to be a very resilient country and quite well prepared for these types of disasters, so hopefully the impact will not be that large.
When it comes to broader Japan markets, it's sort of two camps as we round out the year on a pretty kind of tepid point for Japanese equities, at least, right? There is a lot of people that still believe going into this year, a lot of the same themes have yet to kind of be fully played out. There are still opportunities for gains.
Yeah, so I think if you look at the Japanese market and you assume nothing much changes, then I think it's fairly valued. It's quite fully valued. I mean, it was up 25% last year in yen terms, 17% in dollar terms. So in that sense, I think the easy sort of, just buy a Japanese equity ETF and you make money is over. Maybe not over, but the big returns on that are done. But as your previous commentator said, there's a lot of upside on the yen. It depends on when the BOJ moves and how the Fed moves. But I think if you look 6-12 months out, you have probably at least 15% upside from the yen. And then within the Japanese equities market, for stock pickers, it's, I think, an amazingly good market. If you look at the most recent earnings season, there was massive dispersion in the performance and returns of individual stocks. So you could make or lose a lot of money if you got your stock picking right or wrong. So I think it's really moved into a stock picker's market right now.
Yeah, and you mentioned how undervalued the yen is. I mean, if we're still talking at least 15% upsides here, what is this going to mean for earnings then?
So that is a great question. So I think it's going to have... Okay, it's not going to be as bad for earnings as it used to be because a lot of Japanese manufacturing is now done much closer to the end market. So whether it's in the US or Southeast Asia or even Europe. But there will still be a translation impact. And so I think it's going to be a significant headwind for exporters. However, it's going to play quite positively for domestic Japanese companies in staples and foods and those sort of areas, furniture companies who import goods from overseas. So I think it'll be a nice tailwind for them.
Obviously, there's been a massive. I'm just wondering how are you assessing the portfolio now? Right, what looks overdone to you? What is still a buy right now?
So I think there are two things that are quite overdone in the Japanese market. One, because of the Tokyo Stock Exchange talking about low price to book companies and sort of a naming and shaming theme, I think a lot of those companies have run up too much. A lot of them really don't have a good business model. An example of that would be regional banks in Japan. I mean, even with interest rates going up, their net interest margin spreads are so thin. There really isn't significant loan demand in Japan. 60% of Japanese companies are cash rich, households are cash rich, so there isn't a lot of loan demand. How do they raise their price to book multiple when they can't earn a decent return by lending money, right? So that's one area where I think it's quite overdone. Another area is the inbound theme. One of the things that's an issue for inbound, even though it hasn't, really gone much beyond what it was in 2019, but the problem is there's a labor shortage and there's a capacity issue. So unless Japan solves that sort of labor issue, the inbound theme is, it's at peak inbound. There's little capacity to add a lot more tourists into Japan.
So, Zaher, what would you be shorting?
So there are three groups of companies we like to short right now. The first is companies with weak balance sheets. And an example of this is Japanese restaurants. They suffered a lot during the COVID period. They have very over-levered balance sheets. They run up on sort of the inbound reopening theme. The valuations are very high. And I think most of their cash flows are going to go to repaying debt. And there's a significant risk of very dilutive equity issuance by them. So that's one thing that I think is a good thing to short right now. Second is sort of these companies without a business model, as I mentioned earlier, that have run up, things like regional banks. And then the third is just bad governance in general. With the market up 25%, there are a lot of companies in Japan, I'd say about 30% of companies, that still have very poor governance practices. They do many things that are not really in shareholders' interest, and they've run up with the market, and it's a good time to short them.
All right, Zaher, we're going to leave it there, but thanks so much for joining us. Zaher Khan is Senior Portfolio Manager at UBP, helping us kick off 2024 and a look in Japan. Of course, you can follow more on this story, all the day's trading, on our Markets Live blog that is on the Bloomberg at MLiveGo. Our team back from the holidays and ready to go. You can get a market rundown one click. There's commentary, there's analysis from our expert editors, so you can find out what's affecting your investments right now.
Well, last year saw record deployments of renewables and electric vehicles around the world in the run-up to COP28 in Dubai, which delivered a historic deal to move away from fossil fuels. Bloomberg's NEF's head of APAC, Ali Azadi, joins us to take a look at what 2024 has in store. So, Ali, how are you setting your expectations for mature clean technologies, solar, wind, EVs going into this year?
So we expect the growth to continue this year as well. Let's start with solar first. 2023 was a record year for solar. We actually had to revise upward our forecast a few times during the year, primarily due to significant growth in China, which installed more than 200 gigawatt of solar in 2023. For 2024, we expect that global installations will exceed 500 gigawatt. To give you the 2023 number, we estimate globally that number was around 413 gigawatts, a significant growth. And China, of course, remains the biggest market. This year, though, we expect a growth rate to be higher in the rest of Asia, particularly South and Southeast Asia. Wind has had a lot of challenges since the pandemic, but still had a fairly healthy growth last year. So we estimate that last year annual installations reached just above 103 gigawatt, so about 17% growth year on year. And for this year, we expect that number to reach 115 gigawatt. Again, in APAC, China will remain the largest market, although we see significant activity in India, in Southeast Asia, in Japan and Korea. Electric vehicle sales, despite some of the negative headlines that we saw throughout the year last year, still had very healthy growth. Annual sales, we estimate, just exceeded about 14 million units globally. That's only about 2% lower than our original forecast. And for 2024, we're expecting that sales will exceed 16.7 million. Again, China will be the largest. China may have sales reaching close to 10 million in 2024. And then in the rest of APAC, Japan will see healthy growth. It will be the first year we expect that EV sales will exceed 200,000 units.
Wow. Ali, what about some of the more challenging areas, right? You're talking about clean hydrogen production, for example, carbon capture and storage. Are we seeing improvement in some of these technologies?
So there's been definitely a lot of talk, but we're seeing now more action. So for clean hydrogen production, for example, to put the numbers in context, in 2022, we tracked electrolyzer shipments of about 0.9 gigawatt, so just under 1 gigawatt. This year, we may see shipments reach as high as 5 gigawatts, over 5 times growth. And that growth is now spreading all across the world. China used to be the largest electrolyzer market. It'll still will be the single largest market, but we're seeing growth all across the world, but also in other parts of Asia. So we're expecting activities in South Asia, in India in particular, but also Japan and Korea. CCS, carbon capture and storage, a little bit more difficult. Most of the action still in North America, where there's generous incentives in play. Here in APAC, the one to watch will be Japan, where they're expected to actually release regulations around storage as part of their CCS roadmap this year.
Ali, we touched on this a little bit earlier. Obviously, a massive election year. What are you watching for in terms of key events?
So the elections will be very critical for the progress of energy transition, even though technologies such as solar, wind, and electric vehicles are now becoming more and more economically competitive in many markets. Still, that pace of deployment, as well as, of course, the investments in scaling up of new technologies such as CCS will require policy action. On that note, in APAC, the first one to watch will be the Taiwan elections on January 13. If the opposition wins, we may see a shift on the current government's anti-nuclear stance, so we may see a revival of nuclear power in Taiwan. Then the next one to watch will be the February 14 general election in Indonesia. Among the contenders there, if, for example, the former Jakarta governor, Anies Baswedan, wins, he's the most progressive and will likely see an acceleration towards energy transition. On the other hand, if one of the other traditional candidates win, then we'll probably see a continued challenge of dependence on coal in that market. There are several other elections. For example, India will head to the polls from mid-April, and South Korea also has its legislative elections in April. Those are unlikely to have a significant impact on the direction of energy policy in those countries, regardless of the results. The one that globally will be very critical is, of course, the U.S. elections on November 5th, just days before COP29 is set to start in Baku on November 11th. If we see Trump 2.0, then we may have some challenges with the U.S. again shifting away from climate diplomacy.
Plenty at stake, it seems, Ali. Thank you so much for highlighting all of that for us. Ali Azadi there, our Bloomberg NEF APAC head, joining us out of Seoul. We got plenty more to come on Daybreak Asia. This is Bloomberg. You're watching Daybreak Australia. The top corporate stories we're tracking for you this morning. Saudi Arabia's Public Investment Fund was the world's most active sovereign investor last year, as Singapore's GIC and Temasek slashed spending. Data from consultancy Global SWF shows the PIF deployed more than $31 billion in 2023. State-owned funds invested $125 billion last year. That's down by a fifth from the previous 12 months. The decline was led by the GIC, which invested 46% less. Chinese automaker BYD sold over 526,000 fully electric vehicles in the fourth quarter. That means Tesla will need a record showing to maintain its #1 status when it unveils its own sales figures later on Tuesday. In total, BYD sold more than 3 million electric and hybrid vehicles last year.
Well, Von Carnival CEO Josh Weinstein says that the cruise operator is already 2/3 booked for 2024. He told us the demand is coming from shifting consumer priorities rather than just post-pandemic revenge tourism.
2023, we wrapped in November, on November 30th, and the one word that we like to use as a summary is record. We had record demand, record yields, record pricing, record bookings, forward bookings, record onboard spending levels. So really across the board, our business has really thrived in 2023, and we expect much more in 2024.
It could continue because you're such a great gauge of how customers are feeling. You just have a great read on it. Are they continuing to spend? Are they continuing to do advanced bookings? And then once they're on their ships, Josh, continuing to spend as well?
Yeah, that is exactly what we see. As a matter of fact, our Q4 was, from a pricing standpoint, the highest all year. So it's accelerating; it's not decelerating. And then when we look forward, we're actually 2/3 booked for all of 2024 already.
It's nice visibility.
It's not too bad. We're about 10 points higher than we were last year, and on top of the ticket bookings, we've actually started pulling forward onboard spend. So we have more or less about a third of our onboard spend being prepaid in advance. So we have a really good amount of visibility. And those booking trends, they just haven't slowed down. Every quarter this year, people expected it's gotta slow down. We're gonna see something. The consumer's gonna get impacted. And the fact is, with our business, we haven't seen it. It's record after record. And as a matter of fact, we just ended the 2 weeks of Cyber Monday and Black Friday at more records. And it's not just coming from one brand. It's not coming from the United States. It's global. It's with our global portfolio of brands, which is really, really encouraging.
Do you think we're moving? Good morning. Good to meet you. Do you think we're moving from many CEOs similar to yourself that I've sat with that run global airlines and global businesses have said, we've lived through a period of revenge tourism. We were all locked up for a period of time. This is something, we had this parabolic reopening and you had a parabolic rebooking. Are we evolving into some kind of new cycle? You say there's no end in sight in this demand. So if we've ended revenge tourism, how would you describe the next evolution?
Yeah, that's a great question. So we don't think this is revenge anymore. This is not pent-up demand. It's 2 years on from when we really got back in full as a corporation. This is people who have decided what's meaningful for them. How do I want to spend my life? And experiences are what they're looking for. Unforgettable memories and creation with friends and family. And that's exactly what cruising has to offer.
And that's what I sat down with the Accor CEO and he said, look, I haven't got enough hotel rooms.
All right, let's take a look at how we're tracking in this early part of trading in 2024. Pretty quiet, as you can imagine. Volumes particularly thin on the ground when it comes to trading in Sydney. Of course, January is a very quiet period for this market. But of course, in addition, we have Japanese markets closed for a public holiday. We are seeing Sydney stocks advancing about 0.25%, 0.2% there, I should say. In New Zealand, we're really not seeing that market do much of anything. It's been stuck at, just a marginal gain pretty much all morning session. Nikkei futures are pointed to a bit of muted downside, perhaps not as much, given we are still taking into account the aftermath of the New Year's Day earthquake, the tsunami warning, some of which is still in place for parts of Japan. Market opens in Seoul is next. This is Bloomberg.
This is Daybreak Asia. We are counting down to Asia's major market opens. Good morning, everyone. Happy New Year. It's the first trading day of 2024. Of course, the key question for investors is, can we continue what we saw in the last month or so, this sort of risk rally that has been really quite broad-based, right? Maybe with the exclusion of China, but certainly, is there still that much cheer as we count down? Well, we're not done. We're done counting down. We're starting a new year now, Heidi.
Look, I'm still somewhere around Christmas, to be honest, still catching up to the fact that we're now in 2024. As you mentioned, not a great deal of cheer for China, right? Will that change? Will that stimulus effect finally start to, gain some traction? We saw a fairly nuanced, balanced view from President Xi Jinping in his televised address, really acknowledging some of the shortfalls, some of the challenges going forward. And we know that for the global economy and certainly the geopolitical space as well, it is a big year filled with elections, kicking off with Taiwan in the coming weeks, and then, of course, all the way through to November, where we have the US presidential election. And of course, all of this happening at a crucial time for the central banks. Have I missed anything when it comes to some of these challenges? Let's get you straight to the market open. It is pretty holiday thinned in terms of these trading volumes and interest that we're seeing. Japan on a public holiday. Of course, we're still watching these latest developments when it comes to the New Year's Day earthquake and the tsunami warning. Some of that still taking effect across large parts of Japan as well. But take a look at what we're seeing when it comes to trading in South Korea at the moment. The Kospi just coming online. We are seeing upside of about 1.6% at the start of trading. We're also watching, of course, the impact when it comes to the weakness and some of the volatility that we saw in the dollar, and whether that will potentially play into a bit of a better year for Asian currencies, which we saw Asia dollar currencies at least going into a third straight year of declines. Right, this is a picture as we see the open of trading in Korea. We're also watching Singapore assets today. We did already have an indication of what to expect from that full year number. Singapore's economy avoiding a recession in 2023. We heard that from Lee Hsien Loong, warning though of a troubled international environment that will weigh on growth and security, particularly for an externally vulnerable economy like Singapore's. We're getting that seasonally adjusted quarter-on-quarter, fourth quarter number for the GDP number, 1.7%. That is better than expectations of 0.7%, and also a bit of a strengthening from that 1.4%. That GDP number year-on-year, 2.8%. A bit of a beat on expectations, but of course, as we heard from Lee Hsien Loong, a lot of external vulnerabilities there.
Yep, we're taking a look at Australian markets as well. You take a look at how the ASX is doing here right now. I mean, it is pretty slow going, and we're just about seeing gains about a third of 1%. So at least when it comes to stocks, you're seeing a bit up here today. 10-year yields on Australia, we're up about 1 basis point. We're getting ever closer to that 4% level here right now, but we are heading for that 1 week high when it comes to some of these real yields in Australia as well. So something to keep in mind. Aussie dollar is flat. Crude is pretty much flat as well. We're only up about half of 1%. But really, it is slow going. It's pretty tepid to start the week. Again, as you talked about with Japan, markets closed. Certainly, that is certainly leading to some volumes being quite low here right now, Heidi.
Yeah, let's bring in Mark Matthews, Head of Asia Research at Julius Baer. Mark, going into the start of this year, it's been much ado about valuations, right? Particularly when it comes to some of these exceptional markets like the US, where we are seeing levels pretty high, but you've been crunching the numbers and potentially see more value to come?
Yes, I think so, Heidi. The earnings bottomed in the third quarter of last year, and in the fourth quarter they grew, I'm sure. And looking forward, we're looking for about 10% earnings growth in the S&P both this year and next year. So that would put the S&P on around 17 times by the end of next year, and that's not an expensive multiple.
Mark, how much, we were just talking, and we'll have a little bit more kind of to fill out the picture when it comes to geopolitics and the political risk, really globally, right, with so many elections. Is that something as a theme that you're paying attention to?
Most certainly. The biggest one, of course, is the election in the United States. That's a geopolitical risk for sure. And right now, if you just go by the polls and the betting websites, it looks like it's going to be Trump 2.0. But I would simply say that as much as that could cause a lot of, chaos in politics, if you just think back to Trump 1.0, it was good for the stock market. The first 3 years he was in office, the market returned 35%. It wasn't until COVID came along that things got rocky for the stock market. And so, yes, there's lots of geopolitical noise, but I think that overriding that is the fact that the economy will still grow. Inflation has come down, and therefore so too will interest rates.
And what's been dominant in the narrative is, of course, Fed, cuts this year potentially, Mark. What does it mean for U.S. stocks in particular? I mean, lower rates obviously good for valuations, but what if there's a recession within 12 months or so? Will the economy remain strong? And do you think earnings expectations, can they actually hold, Mark?
Well, it really depends on what kind of recession, Yvonne. So there's big ones and little ones. A big one like 2008, all bets are off. The market's going to go down no matter how much the Fed cuts. But I can remember, kind of embarrassed to say, I can remember the recession in the early 90s in 91, 92. And actually, the market was fine if you take it on a 2-year view. It was up about 25%, despite the fact there was a mild recession in 1992. So anyway, yes, I mean, I think that, let me just say that if you look at all the major economic indicators and compare them to what they did after yield curve inversions in previous episodes, the economy today is incredibly strong relative to those previous times. And I mean, I do think it's going to soften because of these high interest rates. But as rates come down, we should get the economy growing faster again in the second half of this year.
Obviously, it seems that you're still quite bullish on the U.S. Is it just the Magnificent Seven, you think? I mean, what is this whole AI rally going to be? How is it going to play out for 2024 now? Or are other parts of the market going to catch up?
Well, we like healthcare, specifically these obesity drugs, which have done very well, no doubt about it, and biotechnology, which has done really, really badly, but should benefit from lower rates. But I have to confess that the thing we still like is the big technology stocks, and the reason for that is very simply that their revenue and earnings growth will be significantly above the other stocks for the next couple of years. And usually stocks outperform when their earnings are rising faster than the broader market.
Mark, I've got to ask about China, of course, just on the other end of the spectrum in terms of the doldrums that we've seen, and take a look at, we've sort of compiled what certainly at least private economists are expecting from the Chinese economy in 2024, just, I guess, sort of a muddling through year. Do you see this as 2024 a year of more the same, no big policy measures, no big structural changes, or is it more of a fork in the road? What policy choices do they have at this point for the outlook to materially improve?
Heidi, I think it's going to be another tough year for the Chinese economy because President Xi has made it very clear that on the economic front, his priority is bringing down the size of the property sector and its importance in the economy. And it is too important. He's right about that. And there's too much excess inventory, and that process is painful. Now, if it ever became such a big deal that it had the possibility of creating a systemic risk, I'm sure they would step back. But I'm not really thinking it's going to be a great year and growth rise maybe 4 to 5%. Let me just throw in, though, that from a stock market perspective, Hong Kong has an extremely clear link to the Fed funds rate because of the Hong Kong dollar peg. So irrespective of what the Chinese economy does, I think that possibly the best market in the first half of this year is going to be Hong Kong as the Fed cuts rates.
All right, well, let's see how those property stocks do. Mark, thank you so much for joining us. Happy New Year. Mark Matthews there, head of Asia Research at Julius Baer. Let's get to one of our top stories here this morning as well. Authorities in Japan are warning that there may be further aftershocks following Monday's powerful earthquake. The magnitude 7.6 quake on the northwest coast killed at least 6 people and triggered a widespread tsunami warning. Joining us now from Tokyo is Bloomberg's Isabel Reynolds. Isabel, what's the latest?
Right, as you say, yes, there have been 6 reported deaths so far in Ishikawa Prefecture, which is on the northwest coast of Japan. Fortunately, this area of Japan, the northwest coast, is relatively little populated, which I think is one reason that's contributed to the small number of casualties so far. However, obviously roads have been damaged, transport links are very much damaged by this earthquake, so it's very possible that the number of casualties could rise in the future going forward during the day. Also, we've seen like several dozens of people taken to hospital. We're hearing that water supply has been cut off in some areas, which is making treatment difficult, and about 40,000 households have been cut off from electricity.
The significant impact on infrastructure, Isabel.
Yes, it certainly is. And we're seeing, as I said, those roads are blocked. If you look on television and social media, the extent of the damage to the road seems to be enormous. It's already, it's a rather sort of picturesque and touristy area, in fact. The city of Wajima, we've seen this huge fire, and that's probably partly because these areas have a lot of sort of old wooden buildings which can catch fire quite easily. As of this morning, the firefighters were still trying to tackle that blaze, which had spread across more than 50 buildings in this sort of well-known fishing market area that tourists like to frequent.
Well, tell us about, there are some nuclear plants in that area. Isabel, just tell us a bit more about them. And really, is there a risk now to the electricity supply more generally there in Japan?
Right. Yes, you're correct. There are 2 nuclear plants in this vicinity. One of them, Shika, has been offline for a long time and was nowhere near being restarted for the moment after the Fukushima nuclear disaster more than a decade ago. But also in the area, we have the Kashiwazaki Kariwa plant, which is the largest one in Japan. And this is a key one for Japan's energy policy going forward, for its climate change policy. Japan very much wanted to restart this plant, but with this huge quake, although there hasn't been significant damage to either of the plants as we know at this moment, it will cast fresh doubts over whether restarting these plants is a good idea.
And back to Isabel Reynolds there in Tokyo. Much more to come here on Daybreak Asia. This is Bloomberg. We're watching Korean ship makers this morning with a Bloomberg scoop revealing new steps from the US to limit Beijing's ambitions across the key tech sector. Dutch semiconductor equipment manufacturer ASML has now confirmed that it cancelled shipments of some of its machines to China. Anna Bow is following these developments. And actually, we were just talking about it earlier and how, start of the new year and we're seeing these policy measures really continue to take effect.
Yeah, that's right. So the US had put in place these export restrictions on semiconductor manufacturing manufacturing equipment to China. And so they took effect on January 1, and it was also involving its allies, key allies in that process, the Netherlands and also Japan. What we're understanding, though, is that certain companies got ahead of those restrictions taking effect. And the one really in focus this morning is ASML. So it's really important to understand just how significant ASML is on a global scale to semiconductors, because they produce extreme ultraviolet lithography machines. Now, there's a lot of details in that, but what you need to understand about an EUV lithography machine is that it has that capability to print tiny features that go onto microchips. And ASML has a complete monopoly over this market on an international scale. So it's extremely vital to the chip-making process overall. As I said, we know that the US wants to limit China's advancements in producing semiconductors, and we saw really the effects of that at the end of last year, because Huawei put out a smartphone that had that 7-nanometer chip. It was seen as a bit of a breakthrough, but they actually importantly had produced that chip with the aid of ASML's machines. What we understand is that ASML had in place 3 licenses to export 3 of its ultraviolet lithography machines to China by January. Those shipments have not actually gone ahead. They were cancelled at the behest of the Dutch government, but we understand that the Biden administration was certainly pivotal in pushing for the Dutch government ban. ASML has confirmed that Bloomberg scoop that came out over the weekend. So something very significant to watch in terms of just how seriously the US is taking China's capabilities in this field.
Yeah, it's interesting, she even, telling Joe Biden that he hopes the two nations can coexist peacefully. But, there you see the tensions here between corporates now. We also heard from President Xi in this New Year's address and really kind of addressing some of these economic challenges. Let's take a listen.
On the road ahead, wind and rain are normal. Some enterprises are facing operational pressure, and some people are encountering difficulties in employment and life. And natural disasters such as floods, typhoons, and earthquakes have occurred in some places, all of which I'm deeply concerned. We are not afraid of hardships. We will watch out for each other, face up to the challenges, and overcome the difficulties.
So did spend some time at least talking about those tough times. That is certainly a sort of a rare omission from the president, Belle.
Yeah, that's right. We don't really hear this too much from Xi, but of course it's pretty hard to ignore that backdrop that we had in China over the course of last year as well, because there was the persistent property sector slump, for instance. There were issues with unemployment, that high youth unemployment in particular, with those figures eventually being pulled as well around the midpoint of last year, the market rout. So yeah, you do have that element of concession coming through, but it's equally important as well to consider just how Xi plans to respond to those challenges, and that was another focus of the address that came through. So, for instance, there was a pledge to strengthen the economy, to create more jobs, to provide better opportunities for young people, and as well, just a little bit of grandstanding on some of the progress that China has made in terms of its homegrown projects. We spoke about the chip sector. That's really a key one to watch, but there was other things that he mentioned as well. Locally made cruise ships, space programs, passenger jets. So some of the achievements really that were touted as well.
That was the good. On the flip side, the economic weaknesses persist.
Yeah, that's right. I mean, we really saw it over the weekend because we had the PMI data that came out on Sunday, and it just really showed those persistent challenges that are coming through. So factory activity, big contraction there, shrinking to its lowest level that we've seen in about 6 months. You can see in this terminal chart here, you've got the manufacturing side coming in at 49. Actually, economists had seen a reading of 49.6. You've also got the non-manufacturing side as well. A little bit better numbers coming through there, but really pointing to more of the fiscal support that's come through, not really a sort of pickup in any sort of genuine activity there. Services as well, that activity still in contractionary territory, so below that 50 reading. So really what economists are saying out of this is it just puts more pressure now on policymakers, and some, including ANZ, our Bloomberg intelligence team, they're saying that we could actually start to see rate cuts as early as January, so this month.
All right, Belle, thanks so much. Of course, we're still waiting for those Caixin numbers to come out, too, out of China. The president also had told his U.S. counterpart, President Biden, that their countries should strive for a peaceful coexistence. In a New Year's Day letter commemorating diplomatic ties, she noted China-U.S. relations have contributed to global peace and stability. Ties between both countries have steadied since she and Biden met in San Francisco last November. Ukraine says it shot down almost 90 Russian drones on New Year's Eve as the war grinds towards a third year. Now, it followed Russian missile attacks over the weekend that killed at least 30 people in Ukraine. Moscow has said it would seek revenge for a missile strike on a border city that killed at least 24 people. A series of tit-for-tat aerial assaults has intensified recently with the ground conflict in a stalemate. Meanwhile, Israel's Supreme Court has overturned a law aimed at weakening judges' powers in a blow to Prime Minister Benjamin Netanyahu. 8 judges voted to overturn, with 7 in favor of keeping a law which would have barred them from voiding government decisions. The law was part of a populist overhaul which split the nation, with thousands of people taking to the streets to protest the planned changes.
Iran has dispatched a warship to the Red Sea after the US Navy destroyed 3 Houthi boats on Sunday. The move could be seen as a challenge to the US-led maritime task force established to halt attacks in the area. It also risks ratcheting up tensions in the waterway that handles about 12% of global commerce. Bloomberg's Michael Heath joins us now. Does this seem to you like an escalation of the risks in the area?
Yeah, it can't not be, Heidi. I mean, if you have, Iran and the US have been opposed for more than 4 decades. You've got US warships there, and also some of their allies patrolling this to try to protect shipping from the Houthi rebels. Then to have an Iranian warship, conduct a tour across those straits, it just has accidents can happen in these sort of tense situations. So obviously it does increase tensions, but whether we go any further, I mean, unless there's an accident, whether things go any further, I think is highly unlikely, because the US and Iran have been conducting almost a shadow play during the course of this entire conflict between Israel and Hamas in Gaza. They're enemies. Everyone understands who's backing who. Iran provides finance and support for Hamas, for Hezbollah in southern Lebanon, for the Houthis, who have been shooting at these ships as well, in what's called the axis of resistance. But no one, the US side certainly doesn't want to see this escalate, because it can support Israel, and Israel can conduct its operations. Whether everyone can, once it spins out of control, no one knows what will happen there.
And in Gaza, we're hearing Israel is pulling troops out of the area. Is this a sign of a change in a new phase in this war now, Michael?
Yeah, it seems so, Yvonne. The reporting is basically saying that Israel is very keen to do this because it wants to support its economy, which has been hit very, very hard, obviously, by withdrawing 300,000 reservists were called up, and that obviously withdraws a lot of labour from the economy. So outside of the costs of the war, that's obviously hit the economy as well, so it supports that. But yes, in terms of the war, it does suggest the beginnings of a change in it. It's only a few thousand troops we're talking about, but what it suggests is we're now moving to a more targeted approach of more precision strikes. I mean, that's difficult to actually undertake in war, but the difference between that sort of large-scale ground campaign that we've been seeing, that's created a lot of civilian casualties, to more sort of targeted approach, which the US has certainly been pushing Israel to adopt.
And in terms of the international reaction we saw in the last few days, South Africa bringing the case before the International Court of Justice, in addition to, of course, the ongoing investigations at the ICC as well, this is not going to necessarily impact the outcome of the war. But what does that tell you? Yeah, look, I mean, you're right. It's a little bit like the UN in a way, Heidi. It's just a symbolic sort of issue, but it is an interesting one. I mean, the court could rule that this does constitute genocide. I mean, genocide is so difficult to actually define, because it requires intent and all these sorts of issues. But it's very worrying, I think, for Israel in terms of international
political opinion, and they responded harshly. They accused it of, they said it was a blood libel, which sort of hails back to the Middle Ages. But the history between Israel and South Africa is fascinating. Israel obviously was allied to the apartheid regime. The ANC were allied to the PLO, Palestinian Liberation Authority, and it's almost organisation, and that's almost sort of continued through to now. But yes, it doesn't help Israel's public relations campaign internationally.
Bloomberg's Michael Heath there. Here in Sydney. Much more to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. The top corporate stories we're tracking for you this morning. Saudi Arabia's public investment fund was the world's most active sovereign investor last year, as Singapore's GIC and Temasek slashed spending. Data from consultancy global SWF shows that PIF deployed more than $31 billion in 2023. State-owned funds invested $125 billion last year. That's down by a fifth from the previous 12 months. The decline was led by the GIC, which invested 46% less. Chinese automaker BYD sold over 526,000 fully electric vehicles in the fourth quarter. That means Tesla will need a record showing to maintain its #1 status when it unveils its own sales figures later on Tuesday. In total, BYD sold more than 3 million electric and hybrid vehicles in 2023. That's almost as many as the previous 5 years combined. And the U.S. is cutting the number of electric vehicle models eligible for a $7,500 consumer tax credit as new rules kick in from January. The narrower criteria have slashed the number of qualifying models to 13 from about 24, and the new rules exclude EVs that use battery components made by Chinese manufacturers. We've got plenty more to come on Daybreak Asia. This is Bloomberg. Take a look at the state of play when it comes to trading around the region. Of course, Japanese markets are still on holidays today, so it is pretty thin volumes and interest that we're seeing, particularly here in Australia. We are looking pretty flat at the moment, about 0.4%. We are seeing quite a bit of strength when it comes to energy and oil stocks. Energy up by over 1%. That is really the outperformer of the day. We're seeing crude prices advancing. We saw the Iran warship entering the Red Sea following those boat attacks. The US Navy sinking those Houthi boats, and that is sort of creating quite a bit of concern over the risk over energy markets. WTI, though, for the year 2023, declining about 11%. That was the first annual drop since 2020. The Kospi is up by 1.6% at the moment, the clear outperformer across the region. We're also seeing really not much when it comes to trading direction out of New Zealand either. Yep, we're taking a look at some PMIs that are breaking here across Asia. Heidi, I'll start with the good news, at least when it comes to December. So Indonesia and Vietnam, I would say, actually showing some improvement here. 52.2 for Indonesia PMI, so that is well into expansion there and improving. Vietnam also 48.9, but still improving, but then still in contraction. What has disappointed, or at least leading a cooling down, you have South Korea, Malaysia, Philippines, Thailand, and Taiwan all seeing signs of maybe slowing when it comes to manufacturing floors, although Philippines, we're still talking about 51.5 print, so that's still expansionary, but the rest are still now seeing further contraction as well. All right, and of course, this also in the backdrop of what we saw in those China PMI numbers, which really disappointed in December, Bell, and you gotta wonder what investors are thinking for 2024, Bell, whether it's now time to call time on this rout in Chinese assets and buy this dip.
Yeah, it's a big question, of course, because we've seen so much speculation. Have we seen the worst for Chinese equities? But every time that investors seem to pile in over the course of 2023, they just seem to get disappointed again. So the question, of course, as we head into 2024, again, how much of that economic malaise or the issue in China's economy has really been priced in at this stage? This is the results coming through from our latest MLive Polls survey, asking investors about their allocation priorities over the course of the next year or this coming 12 months. And you can see here the results. About more than just under a third of them are expecting to actually increase their exposure to Chinese equities. Of course, when they're just so low, really the room is only to grow at this point in time. But still, it does point to a sense perhaps that investors could look to come back to mainland equities, especially when you consider prior readings. For instance, when we ran this survey back in August, or a similar survey, just 19% were saying that they would look to increase their exposure. Let's change on, though, because the risks or investing into Chinese equities does come with some risks. And we also asked investors or survey respondents about this, and around half of them are saying that real estate really does remain the elephant in the room. It is the biggest question mark hanging over the health of China's economy. Local government debt, investment trusts, disinflation or deflation, they're also some of the key challenges facing the economy. Here's what else some of our investors that we spoke to had to say about the outlook for Chinese equities. Take a listen.
We currently don't have any direct exposure to China. For us, our preference is still to find global conglomerates with exposure to China rather than investing directly into that Chinese equity market.
I'll increase, I'll trade it down.
Based on what we see, our allocation is likely to go higher. It was higher this year than it was last year, and we think that will be the case next year as well. China is a good market for relative outperformance. It is also a good market for absolute performance, not just this year, but it has been for years, and we think it will continue to be that way.
So we expect more reserve rate cuts next year and some more policy easing, but not bazooka-style stimulus. Right now, China equity market is priced for a slowdown, growth below 5%, so expectations are low, positioning is very low. So we would be gradual buyers as the property market bottoms into next year.
China has got some good ideas, but the visibility is missing, and as a result, a lot of investors don't want to stay, don't want to commit to China on a longer-term basis, preferring kind of shorter-term trades, tactical trades.
All right, let's ask that question to Raymond Young, Chief Greater China Economist at ANZ. Raymond, obviously the PMI numbers were a bit of a disappointment once again. I'm just wondering, has the economy bottomed? That's one thing. And then, can China really achieve some sort of soft landing this year?
It's very disappointing PMI number. Over the weekend is 49. I don't think that lots of people can expect a drop of PMI in December. We're looking at the GDP growth this year is below the potentially official target of 5%, and we're looking at 4.2% in 2024. At the same time, we try to characterize this type of Chinese slowdown as a structurally driven slowdown in a very controlled manner, which means that from time to time, the government's trying to support the growth momentum through counter-cyclical policy at the same time within the cross-cyclical adjustment framework, which means that we don't see a free fall of the Chinese economy, but at the same time, we have to expect that Chinese economy is not going to grow back to 5% era. But even for this year, we look at 4.2%. But next year, we are also looking at 4.0% 2025 as well. So we see this as a gradual slowdown in terms of the Chinese economy. At the same time, I believe that the authorities are trying to buy time to support more structural reform and to nurture some growth sector so that in the future, the total factor productivity will be improving. I believe that that will be the policy framework that will support this type of control descending, I would say, over. You can call it soft landing, to some extent.
How are you gauging, how this economy is going to play? I mean, it sounds like it's just things are just going to muddle through, right, Raymond? If you're talking about 4% or so growth, is there anything that policymakers are going to do to at least reinvigorate the private sector in any way?
Yeah, I think that at the same time that the Chinese policymakers trying to support some sort of growth momentum through a more proactive fiscal policy, even with this official deficit budget of 3% of GDP. If they see the growth momentum drop too fast, they will issue more local government bonds in order to support the infrastructure project. And even at the central government level, they started to have a bond issuing in order to support some of the special projects as well. So this is how they want to support about 5% growth, and they don't have to be very precise. In fact, to us, growth number is not really the primary concern right now. It's more about the deflation story that is still our major concern, because over the weekend we look at the PMI number. We also look at the price indexes of those PMI survey. It's actually dropped to below 5% for the third consecutive months as well. So I think that now what's faced the major concern facing the Chinese economy is the downward price pressure. I think that's the top policy priority that the government really need to address, immediately. And so we don't rule out an imminent, interest rate cut as well. We're looking at 20 basis point cut for the whole year, but I think the first interest rate cut can be as soon as this month or next month.
So is China, in your view, already pretty deep in that deflationary demand down spiral? And what are the risks that policy support isn't big enough to be able to drag, the private sector, households, businesses out of that confidence slump?
Yeah, I think that's the key concern right now is the private sector confidence and the household confidence, Heidi. We look at the property market, we have seen no signs of recovering. And in fact, for this year, 2024, we don't expect a major recovery of the property market. We might see some 1 or 2 months of stabilization, but overall, I think this is more a structural concern about how the households is looking at the future outlook of whether real estate is an investment vehicle, whether this is still a good way to store the household wealth. So I think that's is a major structural issue. As long as the government is not going to change the overall headline policy towards housing, then it's hard to see a major rebound in the housing market. All the government would do is just trying to ensure some completion and the cash flow of developers so that they offer a put for major developers to go bust and try to rescue the financial capacity and the cash flow. But it is still difficult to see how they're going to change the household expectation of the future demand of real estate.
Would direct payments help at this point?
I think direct payments can also be only support to some of the, for example, consumption during the holiday season, and perhaps support some of the e-platforms so that they will offer some voucher or offer some discount for small ticket item in terms of household spending. So we look at retail sales will still be growing at a single digit. It's not a double-digit growth. It's hard to see that these household or cash hands out can have a meaningful impact on household spending appetite and the investment appetite as well. So at the moment, I think that the governments will only be trying to ensure that the price will not be dropping too fast, so that they may, in the consumer market, they may also encourage a seller not to cut price too fast. In the housing market and property market, they will definitely want to secure the price level so that developers will not faced with a stress sale scenario. And if we see a free fall of property price or the price dropping too fast, that would easily create a systemic event in financial market because of the importance of the property's values in the banking system and also in the entire financial system as well. So I think that just cash hands out is still just a won't have a major significant impact on turn the overall economic outlook in the near term.
No easy options, of course. Raymond, really great to have you with us and Happy New Year. Raymond Yung, Chief Greater China Economist at ANZ. Plenty more to come here on Daybreak Asia. This is Bloomberg.
The reunification of China is a historical inevitability, and compatriots on both sides of the Taiwan Strait should join hands and share the great glory of national rejuvenation. Our goal is grand and simple.
We hope that both sides of the Taiwan Strait can return to healthy and constructive exchanges. We will not provoke or submit, but we will earn the international community's trust and deepen our cooperation with democratic partners so that we can confidently and calmly face the world and China.
The presidents of China and Taiwan, they're giving their New Year messages. And Xi Jinping, as you heard, they're reiterating that reunification is inevitable, while Tsai Ing-wen calling for Beijing to help maintain peace in the region. Taiwan, of course, heading to the polls in under just 2 weeks to pick its next president. Let's bring in our Deputy Taipei Bureau Chief, Cindy Wang, joining us now with the latest. It's interesting what we heard from Xi Jinping. Let's start with that first, talking about how reunification with Taiwan is inevitable. This seems to be kind of stronger language that we've heard from Xi in the past. How do you read it?
Hi, good morning, Yvonne. Yes, so Taiwan's President Tsai Ing-wen delivered her final New Year's address on Monday, and she needs to step down in office in May after 2 4-year terms. So in response to Chinese President Xi Jinping's remarks that China will be reunified eventually, Taiwan's President Tsai Ing-wen said the final decision on what kind of relationship Taiwan should form with China in the future should be decided based on the common will of the 23 million Taiwanese people, and it should be decided in a democratic way. President Tsai also said during her New Year's remark that she hoped that both sides of the Taiwan Strait can return to healthy and constructive exchanges. She said Taiwan will continue to deepen cooperation with democratic allies in the world and to face China and the world calmly and confidently. President Tsai said trade and economic exchanges should not be used as a political tool, and business opportunities should not be used as a political threat. She said it's important for Taiwan to have communication with China, but it would be too much a price to pay if that means Taiwan has to exchange its sovereignty for such communication.
Cindy, we're just about, over 10 days out just until Taiwanese voters head to the polls. How's the race shaping up? What should, global onlookers, investors be watching for?
Yeah, Taiwan will elect its next president and legislature on January 13. This is going to be an election that policymakers from Washington to Beijing will monitor very closely because Taiwan is the biggest flashpoint in the U.S.-China relations. This is basically a three-way race, and the election is essentially about two competing roads. The ruling party's candidate, Vice President Lai Ching-te, who said Taiwan shouldn't go back to the old path of relying on China economically. The only way, the right way for Taiwan going forward is to move closer to the world, and that's the right path to reduce the risk. But the opposition candidates are KMT's Hou You-yi and Taiwan People's Party's Ko Wen-je. They call for closer ties with China and criticize DPP's Lai's previous comments on support for Taiwan independence risk triggering a war across the Taiwan Strait. The opposition candidates believe that only by deterrence and dialogue can de-escalate the tension across the Taiwan Strait. But so far, this is the final day we can mention polls. So far, DPP's Lai is leading in most of the opinion polls. He's enjoying a solid but not insurmountable victory over his rivals. There are just less than 2 weeks to go to the elections. Anything could happen. But if DPP wins the election again, it's going to be a record third term, and it will send a very strong message to a world that Taiwan decides to move away from China. And so China's any following reaction will be worth watching.
Yep. 11 days ago, Cindy, you and I are going to be very busy during that time. Our Deputy Bureau Chief in Taipei, Cindy Wang there. Of course, you get more on the elections. Taiwan Decides, a special report that's featuring Bloomberg's exclusive interviews with all three presidential candidates. Catch it on Bloomberg TV every Thursday in Asia and Wednesday in the U.S. It's also available on YouTube. And yes, me and Stephen Engel will be there next week. This is Bloomberg. All right, Yvonne, this is the time of the year where we start taking a look at 2024 expectations. And, I think you said in the last couple of hours that a lot of the 2023 expectations really never materialized and things turned out very, very differently, be it the calls on the Fed, the U.S. economy, treasuries, and even that, great rebound in the Chinese economy post-reopening that never quite managed to take hold. And these are sort of some of the expectations, almost everything that Wall Street is lining up for in terms of what they're looking for 2024. So, of course, time will tell as to whether they will, prove to be right. But let's take a look at just some of them, right, in terms of what we are actually expecting. Yeah, when it comes to
let's start off with
China, right, that's the big one.
Yeah, and we've been talking about this idea that maybe the economy just keeps muddling along, right? Jefferies doesn't see a big bazooka that investors are hoping for, new normal of lower but potentially higher quality growth. There are sort of, a little bit more green shoots of optimism, though, if you take a look at some of the other investment houses.
Yeah, a little bit. I mean, when you talk about, at least the Fed picture's looking a bit better. Stimulus might finally gain some traction in China. Maybe we see some signs of stability, and maybe, this pessimism has been already, positioning and all that has already been too excessive, right? You move on to the popular trades of Japanese stocks, right? And you got to wonder, how do you look at Japan after this massive rally? I think it was the best one we've seen in a decade, and we're at 1990 highs right now. You have Deutsche Bank basically saying they're actually moving to an underweight now, and there's a lot of questions on what are going to be those catalysts to see further gains moving forward. HSBC, they're still quite bullish, could be an outperformer among DM. Positive opportunities, according to Fulcrum, when it comes to Japanese banks, for example. Obviously, the BOJ still very much that wild card, Heidi.
Yeah, the BOJ is the wild card, and some of those expectations, exiting YCC negative rates from the first quarter, PIMCO seeing underweight duration policy could tighten quite notably. So that is really one of the big risk factors. We're also hearing from Japanese Prime Minister Fumio Kishida speaking now to reporters, of course, talking about that New Year's Day earthquake, the ensuing tsunami and tsunami warning that is still actually in place for parts of Japan. Speaking to reporters, saying they've set up a local task force for the earthquake. We're hearing confirmation from NHK now that the quake has killed 8 people in Japan's Wajima City, where we also know there's a lot of disruption ongoing. We continue to watch that. But of course, one of the big calls going into this year, one of the big uncertainties, I should say, is also where the greenback is headed. For more weakness this year, markets widely expecting the Fed to start cutting rates. Let's bring Bloomberg's MLive strategist, Mary Nicola. So it was quite the year, not in a good way necessarily, if you were long the greenback, and there does look like a lot more sort of structural challenges to come.
Yeah, absolutely. I mean, it looks like the outlook for the dollar looks like there's more weakness to come if we look at some of the key factors that the Fed is looking at. For example, inflation. We had PCE numbers for November in inflation showing that, the 6-month annualized basis is making progress. Another key factor that we were looking at in terms of what the trajectory of the dollar looks like has to do with where real rates are. So let's say take central bank rates, adjust it for inflation. Actually, real rates in the U.S. are the highest among, its peers, among, let's say, the ECB, the Bank of England, and of course the Bank of Japan. So that actually offers the Fed greater flexibility to start cutting rates, especially if it wants to ensure some sort of soft landing or no landing scenario. It would be better for them to start cutting rates early, proactively, and especially if they've seen some progress on their inflation mandate.
So, Mary, I mean, the last few months have been quite interesting, right? With all this kind of broad-based euphoria and people just taking on so much risk. Is that likely to that optimism to carry over into 2024? And how sustainable will it be?
Yeah, we think so. We think there's not much standing in the way right now. For example, let's say you take projections and economist forecasts for the non-farm payroll on Friday or for ISM. You're expected to see some sort of softening in the data. All that is just going to feed into that dovish Fed narrative and of course, once the Fed does start cutting, the market is going to just be very exuberant that the Fed won't stop. And that's what brings the dollar further lower.
MLive strategist Mary Nicola there. Looking at the trajectory for the greenback going into 2024. Well, that is it for Daybreak Asia. Our markets coverage continues next. This is Bloomberg.